Great. I'm so glad you all fell for the title of this session. It was really, I think, if you speak to John and them and the organizer, it was just to get you in the room. I'm really just joking. The auditors are there anyway, right? The question is it the same auditors that will be coming? So, thank you and welcome everyone to this session. We have 45 minutes and my presentation is just over 30 minutes or so I will allow some questions in the end. But really, thank you for this opportunity, and to the organizers, thank you for inviting us and the RBA and in me in particular. It is an honor for me to speak to you today about evolving audit in a changing environment. That's a better topic, right? But it does impact everyone. Everything that's happening in the current environment impacts each and every one of us in this room. So recent corporate failures have led to a significant drop in confidence, in public confidence, in the financial system, in the auditing profession. A lot of questions are asked by the public of what went wrong. Do you mind if we close that? Sorry. It is therefore no surprise that there's been some significant changes in the world of auditing. The way we know auditing, the way you know auditors coming to you. If there's auditors in the room, the way you've been performing audits are not going to be the same going forward. And this all impacts on those preparing financial statements, such as yourselves. I try to put myself in your shoes. If I'm generalizing, please forgive me, but I pitched this presentation to people that are preparing financial information, people that are involved in the financial reporting part of the system. And by explaining to you what's happening in the auditing side, and how it impacts you, that is the value that I want you to get out of today's session. So I tried to put myself in your shoes, and I asked myself how these changes impact on me as a finance professional, as a preparer, as an accountant, as a bookkeeper, even as an audit committee member. What can you expect from the auditing profession? I asked myself questions like how stricter audit regulations might impact what I'm doing. What is the difference between a business failure and an audit failure? I'll try to clarify that. What are my ethical responsibilities versus that of the auditor? Is it really that much different? And the big question, will accountants be regulated? I will try to give you some clarity around that. I will also touch on the new standards, the new auditing and accounting standards, and the new code that came into being last year. I will touch on mandatory audit firm rotation audit, changing the audit firm that's doing the audits, and what it means and the implementation thereof. And then I'll also share some restoring confidence projects, things that the IRBA has embarked on in terms of restoring faith in the profession. So I hope I will have something tangible that I can leave with you today, that you can take home and think about and even implement if you so wish. Okay, there you go. So I want to, by way of introduction, give you some background, so we just set the stage. So what is the real role of the audit regulator? Okay, it's not the auditor, it's the regulator. And I'm reading, it's to create an ethical, value-driven financial sector that encourages investment, confidence, and protects the financial interests of the public. Now, surely you'll agree with me that it's not just the auditor's responsibility, right, to make sure that financial reporting is sound. They are coming at the end of the process. But to simplify this role or definition of a role is the regulator basically provides an enabling environment. It's an environment through which audit standards are set, education, the education of registered auditors are determined. There's inspections, and then there's also enforcement where necessary, where things didn't go well and there were negligence or misconduct. The regulator's job is to address those. And it's not to be confused with the role of the professional body. So the role of the regulator is not to serve its members, but it's to enable the members through a licensing, through providing a license. So this is just the role of the regulator, but there are then also the auditors, right? The auditors that we regulate. Then there's also the others, and I'll try to be brief. It's management, the directors of the company, the preparers of financial information and financial statements, accountants, those charged with the governance, internal auditors. All these people have a role to play in providing credibility to financial information that is put out into the public domain at the end for a very particular purpose. It is to drive investment decisions. The role of auditors, they promote integrity of financial reporting. They're building a basis for providing confidence. They by doing so, reduce finance cost. They contribute to the efficiency of the capital markets, and they, in the end, ultimately promote economic growth. That is the role of the auditor. You might ask, have the auditors succeeded in their role? The role of financial professionals, finance professionals, the majority of you in the room is really to produce credible financial information to the auditors. It starts with you, the preparers, the bookkeeping, starting with the transaction. Each and every transaction builds up to form the financial information in the end of the day. The expectation and the role is to act with diligence and integrity due to your fiduciary duty. You are doing it for a particular purpose on behalf of the shareholders. And if there's shareholders in the room, it equally applies to you to understand also that this value chain of financial reporting has a beginning and an end point, and there's many role players in this process. You should know accountants are not currently regulated or rigidly regulated in South Africa. Is that about to change? And I will tell you a little bit more about that in the next 20 minutes or so. So let's look at the regulatory philosophy. I'm still on the background. Really, as the IRBA, we follow a balanced regulation approach, also known as a right touch regulation approach, which is proportionate, meaning we don't inspect or we don't look over the shoulder of each and every auditor. We proportionate, we focus on where we think it's necessary. Consistent, we have to be consistent and fair in terms of what we do, and also targeted. We target risk. We follow risk-based inspections, selections, and a little bit later I'll give you some statistics in terms of inspections that we performed. And you can see then the number of inspections that we perform and the outcome of those inspections. So really the fact remains that the auditors cannot make up for unethical behavior or negligence, whether be it known or unknown, but they do set rules and they do set processes in place to detect and deter non-compliance. Regulation is only effective if those who are regulated are inherently acting ethically with sound core values. It starts with the companies. Before the auditor even comes in, before the auditor is even appointed, it starts within the companies. I want to quote Confucius, okay? Many people like to quote Confucius. I thought today is my day. It's my turn. But I thought this one was really, really hitting home for me. It's very short. I'll read it twice. The strength of a nation derives from the integrity of the home. The strength of the nation derives from the integrity of the home. Now, if Confucius knew this, how many thousands of years ago, surely we should know that integrity starts at the home. It starts when you grow up. It starts with your moral values with which you grow up. So the question that we're asking, we in the business of finance, credibility of the financial reporting system, and we as role players in this financial system must ask ourselves, am I acting with integrity? Every decision that you make, every step that you take, are you acting with integrity? Are you checking yourself that you're acting with integrity? Are you acting in an ethical manner that builds trust? Or do you contribute to the erosion of integrity and ethics in this financial system, financial reporting system? It is a question that we all need to hold ourselves accountable. You're in a role, you're privileged to be in a role to look after assets that belongs to someone else. And it's very, very important that we recognize the role that we have as finance professionals for taking care and making sure that what is entrusted to us is looked after properly. So let's take a look at what's happened recently in the current environment. I have no doubt that you all have WhatsApp and you all have News 24 on your phones, and you know exactly what's going on in our profession at the moment. All these high-profile scandals. I'm not going to even list all of them, but maybe just the top three: African Bank, VBS Bank, more recently Tongaat, Hewlett. These are all things. Something happened there. Steinhoff. Something happened there, and the public wants answers. The public and the investors want answers. So let's look at this. Corruption, public and private sector, not just the public sector. Private sector are rife with corruption at the moment. If you just look at the Zondo Commission, things that come out, you can see the interplay between the private sector and the public sector and how corruption is rife as we sit here, even now. And it's coming out, which is a good thing and encouraging. But yes, corruption is a big problem, and it really points to one thing for me. And this is my personal view. It points to a very, very high agency risk that we're sitting with in South Africa at the moment. What is an agency risk? I'll read the actual definition to you. The risk that the management of a company will use its authority to benefit itself rather than the shareholder, or act in a negligent manner. So that goes to everyone entrusted with a fiduciary duty, including the auditors. There's also agency risk there, because an auditor, there's a trust on that auditor to reveal and to expose if things aren't done properly. And if they don't do it, they're failing also in their agency role. All these unexpected business failures. We have failed corporate governance by those charged with governance, audit failures, lack of professional skepticism, unethical behavior. I can really go on, but I don't want to spend all the time on this. But I think you'll agree with me, we have big problems in our system at the moment. We have really big problems. I want to quote our CEO, Mr. Bernard Agulhas, from a recent article, and actually an August article that was published in, I think in the journal called Without Prejudice. His article is called Turning Words into Actions. I think there's a lot of talk around what went wrong and what needs to be done, etc. But I think the time has come that words are turned into action. I'll read this quote to you, what Mr. Agulhas has said. He says, recent business failures in South Africa have focused attention on auditors, but should we not also recognize that the financial reporting system and corporate governance are not working as they ought to? So it's like, I always use this example, there's a policeman on the corner of the street, and on the other side of the block, there's a murder. And suddenly, the policeman is arrested because there was a murder on the other side of the block. Surely that cannot be true, right? For a regulator and even an auditor. But maybe there's more that regulators and auditors can do. Maybe if the policeman patrolled once or twice around the block, he might have scared off the killer, you know? So it's a very simple example that I'm using, that regulators aren't there to look over everyone's shoulders. There are many regulators, not just the audit regulator. But it really comes back to the decisions that are made by those that at the moment are taking those decisions during running the business. These scandals have created an expectation gap from an investor perspective, because investors can no longer trust the information coming from the financial reporting system. And the scariest part is that I'm adding to this sentence, even if it was audited. So, I mean, information coming out of the companies, published, and it's audited, and then still there's a failure. Surely that is alarming. So therefore, a harsh response is inevitable. Stricter regulation on businesses and auditors is happening, it's coming, hence the title of the session. It's almost as certain as Newton's third law that says, for every action there's an equal and opposite reaction. Regulators have to react to the current environment. And unfortunately, it comes down to more rules, regulations, and more compliance, because that's the only tool that a regulator has to address the situation. How will this impact on you as an accounting and finance professional? Well, to put it simply, there's an expectation that you act with more integrity and that you apply more due care in preparing the financial information. Similarly, there's an equal expectation from auditors to be more robust, more independent. There's an expectation on the regulators to implement more robust oversight regimes, more rules. Unfortunately, I'm open and honest with you today. I'm giving you a heads up what is coming. Higher regulatory cost on the back of all of this. The auditors will ask more questions because they will be expected to do more. They will stay longer, report more issues. In essence, there's more accountability that is brought back into the system. More accountability expected from everyone, including you and I. In the next few minutes, couple of 10 minutes or so, I'll give you a bird's eye view of what's happening at the RBA and in the auditing profession, things that you might not always see as clearly from your perspective, and you can then gauge how this might impact on you. So let's look at the RBA inspection results. Every year, we as the RBA, we issue a public inspections report. Okay, it's an annual report, and what this report does is it summarizes the themes that we pick up and that we report during inspections. The latest report that's currently available is the 2018 report, and it has a title. It's a little bit small if you look at the bottom of that. Okay, this thing isn't actually showing there. Oh. But anyway. Okay, but it's at the bottom there of this, of the front page of the report. And it reads, an urgent call on all stakeholders to improve the integrity of financial reporting and audit quality, to restore confidence in the auditing profession. Obviously, we can only oversee auditing, okay, the audit side of things, but we call on everyone in the process to contribute to improve the trust the lost trust in the auditing profession. We so desperately need it at the moment for that trust to be restored. The report is aimed at a wider audience, to promote a broader audit quality improvement strategy. It encourages robust dialogue between audit committees, management, and the auditors. And this dialogue goes around matters affecting quality in the end of the day, audit quality. It has a very strong public interest focus as well. I think you'll agree with me, it is therefore widely accepted now that the responsibility for financial reporting is not only sitting with the auditor, but with other role players I already mentioned. The auditor, however, auditors like to say that, right? Everyone's responsible, not just them. But however, the auditor remains primarily responsible for the quality of the audit. The auditor must do the audit right. That is what they need to do right. The other role players need to do what they do right. Then there shouldn't be a problem. I really encourage you to read this report. It's not a long report. It's just over 20 pages. It will give you a valuable insight into issues that the auditors are facing. If you think auditors are perfect, please go read my report. It will tell you where the issues are, where the areas of issues that we as a regulator picked up at the auditors. It will give you, but more importantly, the reason I want you to read this report, it will give you a better understanding of what to expect from your auditors. To understand why your auditor is asking certain things, why the auditor is behaving in a certain manner. Because in the end of the day, there's also an expectation from the firms to improve their own processes and to improve quality. There's huge pressure on the auditors. So please go read this report. There is a link on the slide, and it's on our RBI website. You can access the report there. I have one slide that gives an overview of inspection results for the past 3 years. Okay? So these inspections are done based on a risk-based selection. We do a risk analysis of the environment and the auditors, and that informs which firms we visit and which audits we select for inspection. So if you look at on the left side, we inspect 54 firm-wide quality control inspections. So we visited 54 firms in 3 years to do a full quality control inspection. As you can see, only 43% of the firms we visited were satisfactory or had limited improvement required, meaning that the majority of firms that we visited had some significant problems that they needed to address. Moving over to the individual audit engagements, we inspected 622 audits, also called engagements. So out of that 622, 289, which is 47%, were satisfactory with limited or some improvement required. Again, the majority of audits that we select did not really make the cut in terms of quality. Now, the audit file is something that's not open to the public. You don't see it. The public doesn't see it. You only see the audit report. You only see the end product. So we, as the regulator and the firms, in terms of their quality control processes, must manage that the audit was actually done properly. So what I'm basically saying is the inspections shows that auditors are not consistently doing enough work. It means what they're doing, what you're seeing them doing at the moment, this report tells us that it's not deemed to be enough. Maybe that's something that you can take away. It's not good news for you and not good news for the auditors, but that is what the public is expecting. I also want to add into here a lot of findings that we raise as the regulator doesn't necessarily mean the opinion is incorrect. So that is something that I must place that in context. But in many instances, the auditors are not challenging the information that is provided, doing sufficient work on that information to draw conclusions on. A lot of things are taken at face value, and more needs to be done by the auditors to provide an opinion. So let's look at some, how am I on time? Sure. Okay, so time is really going very quickly. So firm themes, just quickly a few themes. We look at leadership, tone at the top, culture at the firms. You look at ethics and independence. We look at acceptance and continuance. Do they have the time and the resources to take on this audit? Does the client have the integrity to be taken on? Or should the auditor have walked away from this audit? Human resources, does the firm have the competence, capability, and accountability to perform the audit work? Engagement performance, that's the quality of the work that is done at file and engagement level. Monitoring, this is the firm's own monitoring of their own quality control system. Is that working? Does it give the leadership a reasonable assurance that their internal controls are sufficient to ensure that the audits they do are consistently at the highest level? And then lastly, auditors are expected to document everything, because if they don't, we have nothing to inspect. So a lot of findings are also auditors might have done the work, but they're not documenting it, or it wasn't done at all. For us, we follow a rule: if it's not documented, it's deemed not done, even if it was done. Because we can only look at what was done and documented at a particular point in time. You might be more interested in the engagement themes. The top 5, some call it the big 5 items of the year so far is revenue. We think auditors should do more work on revenue. There's an inherent risk in revenue, and we believe more needs to be done on revenue. Significant estimates and judgments, more work needs to be done. If there was a valuation, if there's an estimate or an expert's report, those things need to be properly audited. It cannot be taken at face value. Auditors need to do more work there. Planning, field work, and completion. What this is about is the golden thread that runs throughout the audit, from the planning, execution to the completion. Sometimes that golden thread is snapping somewhere in this process. So you can't really follow the risk, the execution, and the conclusion phases of the audit. Audit evidence and documentation, I did mention. And then the new kid on the block on this top 5 list is disclosures, financial statement disclosures. Meaning the audit, we pick up, as the regulator, we pick up financial disclosure issues that the auditor missed or the auditor didn't report. And it made it to the top 5, which is quite alarming, because that's the final product of that the audit opinion actually covers. So to see that on this list is not very good. You might ask, this report is a bit dated. We are busy with the 2019 report, but I can tell you the trends are similar. There aren't major changes to the trends that I've shared with you now. So let's move on. I want to get to, and I see my time is really running, I want to get to a few critical points that I think might be of interest to you. What's causing these failures? What's at the heart of causing all these failures that we're reading about and see every day? My answer is that in addition to unethical behavior throughout the whole process, there's also a break in the lines of defense. In other words, the control system that is designed to keep everyone and everything in check is dysfunctional. The system is failing us. The public don't always understand what the difference is between a corporate or a business failure versus an audit failure. Now, I think it's no secret any business can fail. I mean, if the business model is not sufficient, the business can fail. And there's it shouldn't be a surprise that some businesses can fail. The problem is that often the true state of these companies is hidden from the investors and the shareholders. And even hidden sometimes from the auditors and regulators. And only when it's too late, when the bomb, kaboom. You know, when you pick up the newspaper in the morning, if you're a bit old school like me, still get a newspaper. Sorry to the trees, but you know that first page, it's very important. That's the news of the day. And I mean, if it's scandal, I mean, I must say, your heart sinks right to your feet and say, another one. How is that possible? You know? But only when it's too late, the bad news hits the tabloids. And it hits the investors, and billions are lost in a flick of a switch. In an instant, billions are wiped off the JSE. And in many instances, it is your pensions, my pension, our pensions going down. Your hard-earned money wiped out in a second. So we also have a vested interest to fix this system. So an audit failure, so a business can fail, but if it's concealed, if the truth is concealed, that is the problem. Because business decisions are taken on the premise that the financial statements are fairly presenting. And in the end of the day, it is not the true state of that entity reflected in the financial statements. So if an audit failure is linked to misconduct, there's two elements to this. Either the auditor is not independent or objective, turning a blind eye to the failing state of the company because they don't want to lose the audit fee. They then proceed, despite knowing this company is on the brink of collapse. They proceed to issue an unqualified or a clean audit opinion that gives assurance that the financial statements are presenting fairly in all material respects. Can you see how this is the ultimate setup for a failure? Alternatively, auditors might not do enough work to actually pick up the issues. They don't do sufficient and appropriate work to pick up auditing and ethical issues in terms of the standards, overlooking and not reporting on material issues, and that falls under negligence. So auditors really need to look at two things: independence, their own ethics, also the ethics of the clients that they take on, risk by association. Okay, if you're an upstanding audit firm and you take on a dodgy client, immediately it reflects on the auditor. That's something auditors need to be carefully looking at going forward. The second thing is auditors must do enough work to make sure that they gather sufficient evidence to draw conclusions on. Okay, so as stated before, there's obviously a strong call for accountability of all role players, not just the auditors. Everyone in this value chain is called upon. Let's look at the lines of defense. How could it be that the truth can be concealed despite having all these lines of defense in place? These things are in place. We have all these rules and regulations in place, and then we still see things failing. Let's have a deeper look. So if you look at this, it's a little bit small, but I'll take you through quickly. So on the left, you see the first line of defense is management controls, internal control measures, overseen by senior management. Your second line of defense, your financial controls, your security, risk management, quality, inspection, compliance, all those controls is designed to reveal weaknesses and for prompt remediation, also under senior management's control. The third line of defense, internal auditors. Internal auditors come in, look at the risk, respond to the risk through internal audit procedures, with a reporting line to senior management and the governing body or those charged with governance. These are your three lines of defense. You have senior management on top of that. You have the board, the audit committees on the top of that, and many other committees, ethics committees, etc. Then you have the auditors, the external audit coming in at the end of the process. and then you have the regulator also. So it's all in one picture. In theory, this looks untouchable, but it has failed. It has failed us. So depending on the size of your or complexity of your entity, some of these might not be applicable to your entity, but depending on the size, these are the lines of defense that are supposed to protect the public. Any weakness in this system that is not identified and addressed by the next line of defense contributes to a failure. Okay. I'm not going to spend a lot of time on standards. All I want to share with you is that I see Bruce is presented just before me. I'm sure Bruce shared with you the myriad of accounting standards that are underway and busy being implemented. IFRS 9, 15, 16, they're coming thick and thin. Similarly, in the auditing space, new standards, fundamental changes in how audits are run, how audit firms are run, is underway. Standard setters, and I think it's important to note, failures aren't only happening in South Africa, okay? It's a global phenomenon. Standard setters have already responded globally through international standards to some of these concerns. Like, for instance, ISA, in the International Standards on Auditing 540, was recently revised, dealing with estimates and judgment. You know, more work that the auditor need to do to ensure that the judgments are audited are appropriate. The assumptions are appropriate. So, out of this response, I'm just going to mention there's a new exposure draft on ISQM1. This is the standard that tells audit firms how to run their quality management processes internally. It's basically introducing a risk-based approach. ISQM stands for International Standards on Quality Management. Okay, so we also have a fundamental change is that the internal review process, or called engagement quality control review processes that used to be in the old ISQC1 standard, has been stripped out of the main standard, and it is now known and will be known as ISQM2, which basically deals with the appointment and eligibility of quality reviewers, performance of the review, and the documentation of the engagement review. So it's so important to note that auditors should have controls in their in-house to protect the public, to make sure they don't miss anything. And these new standards are prompting auditors to apply stronger governance principles within their firms. Ethics. Just a quick overview around ethics. You know there's a new code, right? It applies to all auditors and accountants. It came into effect early last year. I want to focus on independence. Independence is the unique element of the ethics code for auditors only. I want you to understand where the auditors are coming from. So, it's unique to auditors. Independence is unique to auditors. It's similar to being objective, but it's very strong. It requires auditors to be independent. And one of the most controversial aspects of the independence is the appearance part, the appearance of independence. So what I want to actually bring across is that there's two elements to the independence requirement to auditors. The one is independence of mind, and the other is independence in appearance. The independence of mind is that you are free as the auditor, free of influence or bias. Independence in appearance, it's creating perceptions to a reasonable third party that something doesn't look right. Okay, I'll give you some examples, some statistics. 18% of CFOs and finance directors of JSE top 40 listed companies were previously employed by the audit firm. that are the incumbent auditors. I'm not saying there's anything right or wrong. I'm playing on your perception now. For 25% audit committees of the JSE top 40 listeds are chaired by a member who were previously employed by the incumbent audit firm. 25%, 1/4. Some firms have audited listed companies for around 100 years. Does that create a perception? Some companies are already rotating their firms because they believe that the long tenure of the firm, not the partner, but the long tenure of the firm is creating a familiarity threat that will impair the auditor's independence. The RBA responded with mandatory audit firm rotation, which is effective from 2023 to prompt auditors to rotate after 10 years. Maximum of 10 years, a new audit firm must come in. At the end of September, 21% of JSE listed companies rotated audit firms since the rule was gazetted in 2017, which is well ahead of 2023. And 41% of this 21%, 41% of these entities cited mandatory audit firm rotation as one of the reasons for their decision to rotate the firm. Some of these firms are there 20 years, 50 years. There's a whole list on the IRBA website you can go and check. So on the back of what I just said, I have a challenge for you in the form of a question. 2 questions actually. Why do the majority of management and those charged with governance resist a change in auditors? If auditors are supposed to be independent, why is there that resistance after long tenure, especially after long tenure? Have they become too close? Do they really understand the critical and fundamental importance of auditor independence? I think that's a critical question we have to ask. The moment there's a defensiveness around changing an auditor should be independent anyway, right? So if you challenge someone changing the auditors, why? Why? You have to ask yourself why. Okay, what is the relationship that you don't want to break? So I'm starting to close. The new code came into being April 2018, and it's applicable to all professional accountants and auditors. So it's very critical that you read this and implement this. There's a link also on our website to this. One last thing, just in the code, nothing has really changed in terms of the fundamental principles of the code. I think they are still there. Objectivity, integrity, objectivity, professional competence and due care, confidentiality and professional behavior, and we added obviously independence, which is particularly important for auditors, but those haven't changed. I think those are still deemed to be appropriate. That is what is expected. These are the principles and the standards and the standard of behavior that is expected from all professional accountants in the public interest to act in the public interest. I think we need to start living these values. Okay, you can just look at that a little bit more around the conceptual framework. I want to get to comprehensive regulation. I'm over time already. I don't know. I need 2 more minutes. Are you okay with that? Okay, I'm sorry. Comprehensive regulation. You're asking, are we going to be regulated? My answer to you is yes. It's underway. 20 years ago, when we had all these failures, Enron, and so mostly in the US, audit regulators were forced to become more independent, but it was left up to professional bodies to regulate their members. So in 2013, the World Bank did recommend in one of their reports, their ROSC report, as it's known, which was adopted by the Minister of Finance, that all accountants, including those charged with the governance, should be regulated and should act with integrity and be held accountable. So a lot of things have gone wrong again since then, like we discussed, all the failures. So really in response, Treasury is currently looking into this project of comprehensive regulation, which will include accounting bodies. So we need to keep an eye out on that. The RBA is also endorsing, and we are sponsoring this idea of comprehensive regulation as a response to the current environment. So yes, it is underway. When, I can't tell you. We're not the custodians of that. So on closing, you can really go through some of the key restoring confidence projects of the IRBA. It's for your own noting. I did talk about the expectation gap. I want to get to the key takeaway points. Stricter regulation, underway. Increased governance expectation, businesses and audit firms. There's an expectation for that. Increased accountability is expected for everyone involved in the financial reporting chain or system. New auditors, you might see new auditors because of this rotation. More robust audits, you might get more robust audits because the auditors are expected to do more. Higher fees, more work results in higher fees. So if the higher the risk in the system, the higher the fees for the auditor, because they must respond to the risk and reduce their audit risk to an acceptable level. Comprehensive regulation, yes, it is underway, so keep an eye out. Restoring confidence, we all need to do our part in restoring confidence. And I'm closing by a quote. Henry Ford said, quality means doing it right when no one is looking. Quality is doing it right when no one is looking. I think the future of the accounting and auditing profession, the economic growth of this country is in our hands, your hands and my hands. It's in our hands. So I'm urging you, let us choose to do the right thing even when no one is looking. Thank you very much for your time.